Yo, what's up everyone? It's Smartiest Money, and let's talk about building wealth. Today we're diving into the world of ETFs, or exchange-traded funds. Whether you're just starting out or you've been in the game for a while, ETFs can be a game changer for your portfolio. In this video, we're breaking down everything you need to know about ETFs, what they are, how they work, and how they can help you crush your financial goals. So buckle up, smash that like button, and let's get right into it. Alright, let's start with the basics. What exactly is an ETF? Imagine a basket, right? But instead of fruit, this basket is filled with different investments like stocks and bonds. That's essentially what an ETF is, a basket of assets all bundled together. So instead of buying, say, 50 different stocks individually, you can buy shares of an ETF that holds all 50, giving you instant diversification. It's like buying a slice of the entire pie instead of just one ingredient. Now let's say you're bullish on tech, right? You think companies like Apple and Tesla are going to keep crushing it. Instead of picking and choosing individual stocks, you could buy an ETF that tracks the tech sector. This way you're invested in the overall growth of the industry without putting all your eggs in one basket. And the best part? ETFs trade on stock exchanges just like regular stocks. This means you can buy and sell them throughout the trading day, giving you a ton of flexibility. No need to wait until the end of the day to make a move. Think of it like this. ETFs give you the diversification of a mutual fund with the flexibility and transparency of individual stocks. It's a win-win. So, we know ETFs are like baskets of investments, but how do they actually work? Well, it's all about the underlying assets. Let's say you buy an ETF that tracks the S&P 500. This ETF will hold shares in all 500 companies listed on the S&P 500 index. The ETF's price will then fluctuate throughout the day based on the combined performance of those 500 companies. Now here's where it gets interesting. Most ETFs are passively managed. What does that mean? It means that instead of having a team of expensive fund managers actively picking and choosing stocks, these ETFs simply follow a specific index or sector. This keeps costs super low, which is a huge win for investors. Remember those high expense ratios you see with some mutual funds? Yeah, ETFs generally have much lower fees because they're not paying for all that active management, and lower fees mean more money in your pocket. Another cool thing about ETFs is that they're incredibly transparent. You can easily see exactly what assets the ETF holds, so there are no surprises. It's all out in the open. So to recap, ETFs track a basket of assets, they're typically passively managed, and they offer a ton of transparency. It's a simple yet powerful investment vehicle. Okay, we've covered what ETFs are and how they work, but let's talk about why you should actually care. Why are ETFs so popular? Well, there are a few key benefits that make them a no-brainer for many investors. First, low fees. I sound like a broken record, but seriously, this is huge. Those tiny percentage points that mutual funds charge in fees can eat into your returns over time. ETFs, on the other hand, are known for their low expense ratios, which means more of your money is working for you. Second, diversification. Remember that basket analogy? That's diversification in action. By investing in an ETF, you're spreading your risk across a variety of assets. It's like having a safety net for your portfolio. And third, flexibility. ETFs trade on stock exchanges, remember? This means you can buy and sell them whenever the market is open, just like individual stocks. Need to free up some cash quickly? No problem, just sell your ETF shares. Want to double down on a sector you're bullish on? Easy, buy more shares. It's all about having control over your investments. So to sum it up, low fees, built-in diversification, and incredible flexibility. It's no wonder ETFs have become a go-to investment for so many people. Chapter 4. Now, let's dive into the different flavors of ETFs. Just like there are different types of cars for different needs, there are ETFs for every investment goal. First up, we've got stock ETFs. These are the most common type of ETF, and they track, you guessed it, stocks. You can find stock ETFs that track specific indexes like the S&P 500 or the NASDAQ, or you can find ETFs that focus on specific sectors like technology, healthcare, or energy. Next, we've got bond ETFs. These bad boys invest in bonds, which are essentially loans that you give to governments or corporations. Bond ETFs can provide a steady stream of income, making them a good option for investors looking for stability. Then we have commodity ETFs. These ETFs track the prices of commodities like gold, oil, or agricultural products. Investing in commodity ETFs can be a good way to hedge against inflation or diversify your portfolio. And finally, we have international ETFs. These ETFs invest in companies outside of your home country, allowing you to tap into global markets and potentially higher returns. The point is, there's an ETF out there for everyone. Whether you're a seasoned investor or just starting out, there's an ETF that aligns with your risk tolerance and investment goals. Chapter 5. How to invest in ETFs. Alright, ready to jump into the world of ETFs? The good news is it's easier than you might think. Here's a quick rundown of how to get started. Step 1. Open a brokerage account. This is your gateway to the stock market. There are tons of great online brokers out there, many of which offer commission-free ETF trading. Do your research, compare fees, and choose the broker that's right for you. Step 2. Fund your account. You're going to need some cash to start investing, so transfer some money from your bank account to your brokerage account. Step 3. Choose your ETFs. This is where the fun begins. Use your broker's platform to research different ETFs and find ones that align with your investment goals. Look at things like expense ratios, past performance, and the underlying assets the ETF holds. Step 4. Place your order. Once you've found an ETF you like, it's time to buy some shares. You can place a market order, which buys the ETF at the current market price, or you can place a limit order, which only buys the ETF if the price drops to a certain level. Step 5. Monitor your investments. Congratulations, you're now an ETF investor. Make sure to keep an eye on your investments and make adjustments as needed. Remember, investing is a marathon, not a sprint. Chapter 6. Risks of ETFs. Now, before you go all in on ETFs, it's important to understand the risks involved. Just like any investment, ETFs come with their own set of potential downsides. First and foremost, market risk. ETFs are only as good as the underlying assets they hold. If the stock market takes a nosedive, your stock ETFs are going to feel the pain. Remember, diversification can help mitigate risk, but it can't eliminate it entirely. Next, up liquidity risk. Most ETFs are highly liquid, meaning you can buy and sell them easily. However, some niche or specialized ETFs might have lower trading volumes, which could make it harder to unload your shares if you need to sell quickly. Then there's tracking error. Ideally, an ETF should perfectly track the index or sector it's designed to follow. However, in reality, there's often a slight difference between the ETF's performance and the performance of its underlying assets. This is known as tracking error, and while it's usually minimal, it's something to be aware of. And finally, concentration risk. This applies mainly to sector-specific ETFs. If you put all your eggs in one basket, so to speak, and that sector underperforms, your portfolio could take a hit. The key takeaway here is that ETFs are not a guaranteed path to riches. Like any investment, they come with risks. Do your research, understand the potential downsides, and invest accordingly. Chapter 7. Conclusion and Summary. Alright, let's wrap things up with a quick recap of what we've learned about ETFs. ETFs are like baskets of investments that allow you to diversify your portfolio with a single purchase. They're known for their low fees, flexibility, and transparency. There are ETFs for every investment goal, from broad market indexes to specific sectors and commodities. Investing in ETFs is easy and accessible through online brokers. However, like all investments, ETFs come with risks, including market risk, liquidity risk, and tracking error. The bottom line is this: ETFs can be a powerful tool for building wealth, but it's important to do your research, understand the risks, and invest responsibly. Outro. Start investing in ETFs today. So there you have it, guys, the ins and outs of ETFs. Remember, investing isn't about getting rich quick. It's about making smart, informed decisions that will help you build long-term wealth. ETFs can be a fantastic tool to achieve your financial goals. So do your research, start small, and watch your portfolio grow. As always, make sure to like, subscribe, and hit that notification bell so you don't miss out on any future videos. Until next time, happy investing.